expect from the local market today? Cameron Peacock joins us from IG Markets in Melbourne. Good morning to you, Cam. Good to see you there. Now, the SPY's tipping gains of about 0.4% there. What are you expecting after that strange night on offshore markets?
Yeah, good morning, Bridie. Look, I think you're spot on. I mean, our current call is for the market to open up about 17 points or 0.4% around that 41.50 level. I think for the local market today, it's going to be all about consolidation of the last two sessions worth of gains and the RBA decision. You know, obviously we started rallying on Friday afternoon. We've rallied the last 2 days. We're in a new financial year. The market does have a bit of momentum behind it, but I think investors are still very wary that, you know, sentiment can turn on a dime and, you know, confidence levels are still fairly sketchy at the moment. Obviously today we've got the RBA decision due out at 2:30. The RBA has cut by 75 basis points, as we know, over the last 2 months. I think it's widely expected that they will pause today to sort of reassess the global and the domestic landscape. So I don't think there's going to be too much going on post 2:30. Obviously everyone's going to be watching the RBA statement. I think we will probably see some rate cuts further on down the line later in the year, but I think everyone's really going to be looking for clues in the statement, you know, dissecting every word to see if there's any clues in terms of how the RBA is currently viewing the economy and, you know, the timing of potential rate cuts later in the year. So I think, as I said, more about consolidation today. The two sectors I'm probably going to be watching closely are going to be the materials and the energy sectors. Obviously in the last couple of days we've rallied on the back of a weaker US dollar and firmer base metal prices. Last night we saw a little bit of a reversal of that. We saw the US dollar strengthening again, base metals coming off again. So it's going to be a real test to see sort of you know, how fickle and how fleeting sentiment is towards those two sectors. They are two sort of pro-growth cyclical sectors, and I think we need to see a sustainable move forward in those two sectors to really get the market firing again.
Well, just on that, obviously we had that weak read on US manufacturing, and that had been one sector that had sort of been the great ray of sunshine for the US economy, that had sort of been helping with the recovery, and now it's back in contractionary territory. What does that tell you, and also the market's reaction to it?
Yeah, look, it's interesting. You know, obviously, as you said, the PMI numbers, I think they came out at 48.6 or 49.7, I think it was, below the 52 that the market was expecting. Obviously, that was a bit of a sour point for US markets, and, you know, really, you know, fueled expectations that the Fed are going to have to get off the fence and do something in terms of more quantitative easing. And I think those calls are only going to intensify this Friday if we do get a weaker than expected non-farm payrolls report. Obviously, and the Fed in recent months have been very reluctant to act. They basically sat on the fence and said, look, we're going to sit and wait. We're only going to act if the economy really deteriorates. And I think everyone's sort of asking themselves, what is that point where the Fed will get off the fence and step in? First contraction in manufacturing data for I think since March 2009. I think I read this morning. Non-farm payrolls reports have been winding back over the last couple of months, having, you know, had a previously strong 6 months. So the economy is certainly slowing. The Fed did predict that. They have said that they stand willing to act and to do more. It's just at what point and what is the tipping point for them to actually step in and do that additional quantitative easing. How
much, I guess, too, obviously you've got that key data, as you're mentioning, at the end of the week, but of course there's holidays in the middle of it with the 4th of July in the US. Will that affect trade? Do you expect it to be a lot more cautious this week?
Yeah, I made that point in my morning comments this morning that the US markets are essentially on holidays from midday tomorrow. Obviously, they've got their 4th of July Independence Day holiday tomorrow. A lot of people take the Thursday and the Friday off as well. So we do have a busy week in terms of economic data. We've got the RBA handing its decision down today. We've got decisions from the Bank of England and the ECB later in the week, and we've got that non-farm payrolls report. So lots of market-moving data, but a lot of investment banks and fund managers and so forth are going to have effectively skeleton staff on for the next couple of days. So it's going to be interesting to see what sort of reaction we do get, but I suspect the real reaction and the real volume might come through next week.
To ask you too about what we saw in European markets overnight, because they were surprisingly strong. Again, what do you think's behind that, given that there are these worries about manufacturing and doubts creeping in about the outcomes of the EU summit? Is it all about the ECB this week?
Yeah, look, I think European markets have still just been carried forward on that momentum that was established last Friday. Obviously, the EU summit initiatives were a bit of a surprise to the market. We saw markets rallying quite strongly on Friday. They rallied again overnight. But I think, the real question for me is that what was announced on Friday were really stabilisation mechanisms. They've stabilised the European banking system, but they haven't actually addressed the longer-term structural issues of Europe, and that's putting Europe on a sustainable growth trajectory. And I think over time the effects of the EU summit initiatives will wane when people step back from the initial euphoria and start to question the growth initiatives going forward. Obviously unemployment rates are still running extremely high in a lot of these European countries. Manufacturing data is starting to come off, so one side of the equation was maybe band-aided over on Friday, but the longer term structural issues still remain, and I think this little rally that we've seen is probably going to run out of legs pretty quickly, like we've seen so many times over the last couple of years.
Just quickly as well on the Aussie dollar, ahead of the RBA meeting or statement due out later, what are you expecting? Because it's been holding pretty firm, even though we've got all these concerns about Europe and manufacturing.
Yeah, look, obviously it popped about 2 cents from Friday's around 12:45 when those initiatives started to come out of the EU summit. We saw the Aussie dollar, rally from maybe 40 basis points over parity to the current levels of around 102, 102.50 thereabouts. So I think it is a real barometer for risk appetite at the moment. Obviously risk has been on in the last couple of days. I think the market is expecting the RBA to stay on hold. If they do stay on hold today, I don't think there's going to be too much of a reaction. It really depends on what they say in the accompanying statement. If they do indicate that there's more cuts on the way later in the year, we could see the Aussie dollar soften. If they seem fairly standoffish in their comments and aren't giving any indications that they're looking to cut later on in the line, we could see the RBA, the Aussie dollar strengthen a little bit more.
Lots to watch out for, Cameron. Appreciate that. Cam Peacock there from IG Markets.